Hi, my name is George Dagnino. One of my subscribers asked me to uh, make a video and discuss the relationship between interest rates and bond prices, which is a very unique relationship, as I will show you. But before talking about that relationship, I wanted to show you what is my thought process to predict interest rates. And one of the things that I found is that commodities of any type, interest rates, inflation, they all tend to move in the same directions at the same time. So what I'm doing with this video, I'm going to show you the indicators that I use to predict these trends. And then once we decide which way the interest rates are going to go, then we'll see what the relationship between interest rates and bond prices is going to be and how we can profit the most from them. Let's see now what is the major cause for prices to change. Then we'll get into the details. But the main reason is changes in the business cycle. This is the curve. Now, when in phase one, the economy starts improving, the stock market bottoms, cyclical stocks shine, financials, industrials, transportation, they're very strong. Eventually, the economy strengthens again. Towards the end here, inflation is rising, interest rates are rising, commodities are rising. In phase three, which caused the economy to start slowing down. In phase three, business realizes that because of rising inflation, demand slows down, purchasing powers decline. So they find out that the inventories now are rising faster than sales. So what you have to do is reduce production, reduce working hours, reduce employment, reduce the purchase of raw materials, and of course, reduce the borrowing to finance improvement in capacity or improvement in machinery. Of this will continue until all the causes that created this slowdown are brought under control, which is interest rates have to decline, inflation has to decline, uh, commodities have to decline. So everything will be corrected in this phase, which is basically where we are in right now for the last year or so. So this is where we are at. Now let's see what is driving interest rates and what is the impact of the factors that impacting interest rates on bond prices. Let's see now what are the forces driving interest rates. And the major indicators that I use are M2 and the yield curve, as I will show you. And M2 and the yield curve, the reason I use them because they help me predict what is the growth of the economy. And they also, because of the growth of the economy, they drive the price of commodities and they drive where inflation is going to go and then where the trend of interest rates. Then in the last chart, I will show you the unique relationship, very unique, of interest rates and bond prices. The two leading indicators that I follow because they lead everything else is the money supply, M2. This is the growth of the money supply, which is now has been contracting for some time. And this means how much liquidity there is in the system. The second leading indicator that I use is the yield curve, which is the difference between the 10 years and the 2-year Treasury bond yields. When this is the scale of the yield curve, and when becomes inverted, that is the 2-year is greater than the 10-year, there is serious credit conditions out there that are becoming extremely critical. So these are two important leading indicators I use. Let's see how I use them to predict interest rates and commodities. This is the money supply M2, and this is the growth of the economy, GDP. What is important about this chart is that the leading indicators, the money supply, leads the change in the growth of the economy by roughly 12 to 18 months. And the same thing here, when it comes down, really the big drop in the growth of GDP took after a year to 18 months roughly. These are the lead time of these leading indicators. That's why it's so important, because they forewarn you what's going to happen way ahead of time. The importance of a leading indicator, of course, is that let's assume that even if the money supply starts growing faster now, we know that the economy is not going to strengthen not before a year and a half. So that's the important thing of a leading indicator. Now this shows again the money supply, and this one is the commodity prices, producer prices. So what you see, the money supply turn up. After a year and a half, commodities started going up. Then the money supply, liquidity decline, slow down, and then decline. And then after a year and a half, now commodities are tumbling. So this is what does it mean? That even if the money supply starts rising now, commodities will keep on declining at least for another year and a half. This is the money supply growing faster, then slowing down again in 2021 roughly, and then slowing down further. Now it's contracting. Liquidity is contracting. What is the effect on the inflation is that inflation, see here, the leading indicator rises, inflation starts really going up after a year to 2 years and a half. The same thing at the peak. The liquidity is decreasing and inflation now has peaked and is going to decline. Until when? Well, it's going to decline well in the next year or so. Why? Because it takes a year and a half, if not more, for inflation to rise after the money supply starts accelerating. That is, there is more liquidity in the system. So this trend is going to continue for some time. That's what the leading indicators are saying. In order to accept what I'm going to say about short-term interest rates, you have to think that short-term interest rates is the price of money. And the price of money, like the price of commodity, it depends how much business needs that money. So we said that right now we are in the phase where business is trying to control inventories, is reducing production, is reducing working hours, is slowing down employment in manufacturing. You saw that commodities are coming down, inflation are coming down. So there is a downward pressure on prices. And again, even on short-term interest rates, which is the price of the commodity money. So let's see the relationship between the money supply, our leading indicator, okay, and short-term interest rates. As you can see, the leading indicator started bottoming, started rising here, and then after a year and a half, short-term interest rates started rising. Now the inflation, the leading indicator, money supply started slowing down, and here it's contracting. And then after a year and a half, commodities stopped rising. So like commodities, like everything else. So as long as, even if liquidity starts rising faster, it will take a year and a half for short-term rates to rise. In the meantime, they have to decline. So the trend of short-term interest rates is the same as the trend of commodities and inflation. Let's see now how this trend is going to impact bond prices, which was the main question we started from. We saw that the leading indicator, the money supply, leads commodities, which is this graph here, and leads also interest rates, which is these two graphs here. But the interesting thing is that the trend of commodities tends to anticipate turning points in interest rates. Here, commodities started flattening out and then declined, and interest rates declined. So the fact that commodities are weak suggests that the odds favor lower interest rates, both short-term and long-term, lower interest rates ahead. So this gives you a sense of what strategy one should follow for the coming months. In the previous slides, I showed you what drives short-term interest rates, And the money supply, commodities, they all point, the economy, they all point to lower interest rates in the coming months. So how do you make money from declining interest rates? Well, what's this chart? It shows you how. My basic approach is that you buy bonds for capital gains, not a little bit for interest, but especially for capital gains. In order to do that, you have to invest, at least I do, in long-term Treasury bonds. There is an ETF called TLT for this purpose. Now, the relationship between interest rates and bond prices is not, in TLT is not linear. So how do I find out? Well, I went back in history and I saw when interest rates are 5%, 2%, 2.5, 3%, 3.5%, 4%. So this axis shows interest rates. Then what I did for every interest rates, this is the price of TLT, I saw what the price of TLT was when interest rates were 3%, the price of TLT was 110%. When interest rates were 4.25%, the price of TLT was $95. When the interest rates were 2%, the price of TLT was 135. So I drew over this curve, and as you can see, is concave in this way, this shape. What does it mean? Why has this shape? What this is saying is that you make less for every 1% change in interest rates, you make less money here. Where you make a lot of money is when for 1% change in interest rates when they are low. For instance, if interest rates go, let's say, from 4%, the price is $100 for TLT, and they go to 2%, which is here, the price of TLT is going to be a 145. So you have a 40% capital appreciation. If interest rates, so this shows you what is the profit potential by investing in TLT. So if interest rates go from 3%, the price of TLT is 110, and they go to 2%, the price of TLT is 145. So this is the capital gain. So this curve tells you what is the price of TLT as interest rates change. Now, if you have an optimistic forecast of interest rate that I do, and interest rates are going to go possibly around 2.5%, 1.5 to 2% from the current 3.8%, the capital gain could be quite substantial. Again, this is not a recommendation, it's just what I think personally I do with the investment in TLT. Well, hopefully this chart is very useful. I think I keep it in front of me every day. Okay. As you know, I publish the Peter Dark Portfolio Strategy and Management. If you go to our website, you can get a free subscription to see what kind of work I do. Which this is really the basis of my work. This I had great reviews. I would really appreciate it. This is the outcome of an MBA course that I taught at a university for 10 years, and McGraw-Hill asked me to write a book about it because they found it very interesting. McGraw-Hill Education has been translated in many languages and is available in Asia as well. So I would recommend, if you're really interested in business cycles, read what people said, and will convince you that you should have it in your library. Anyway, I wrote 2 more books, and all my articles are found in peterdad.com, by the way. Thank you for reviewing this video. I really appreciate it. Thank you for your questions. Please let me know if there is any aspect of the business cycles or all markets that you would like me to present to you. By the way, if you subscribe, I would really appreciate it. It helps sort of the business, so to speak. Okay, thank you, and I'll see you really soon. Take care of yourself.